Product Market Matrix. The Product Market Matrix, ANSOF matrix, is a strategic tool used to identify growth strategies based on products and markets. It helps organizations consider how they can expand by analyzing whether they are selling existing or new products in existing or new markets. The matrix contains 4 strategic options: market penetration, product development, market development, and diversification. These options vary in terms of risk and complexity. Managers use the framework to evaluate possible strategic directions and understand the level of uncertainty involved in each choice. By mapping strategic initiatives onto the matrix, organizations can generate structured options for growth and align these options with their capabilities and external market opportunities. Market penetration focuses on increasing sales of existing products in existing markets. This strategy is typically the least risky because the organization already understands both the product and the customer base. Companies may achieve this through actions such as price reductions, increased advertising, improved distribution channels, or promotional campaigns. The aim is to increase market share and encourage existing customers to buy more frequently. Market penetration may also involve persuading customers to switch from competitors' products. Because it relies on familiar products and markets, it generally requires fewer new capabilities compared with other strategies. Although intense competition and price pressures can sometimes limit its effectiveness, market development and product development strategies involve moderate levels of risk because they require changes to either markets or products. Market development involves selling existing products to new geographic markets or customer segments. This could include international expansion or targeting different demographic groups. Product development, by contrast, focuses on introducing new or improved products to existing markets. This often requires investment in research and development and a strong understanding of customer needs. Both strategies rely on leveraging existing capabilities while expanding into new opportunities. Managers must ensure that the organization has sufficient resources and knowledge to support these strategic initiatives successfully. Diversification represents the most risky growth strategy because it involves entering new markets with new products. Organizations pursuing diversification may move into completely different industries or develop products that differ significantly from their existing offerings. The risk arises because the company lacks experience in both the new market and the new product area. However, diversification can also offer substantial rewards if it enables firms to exploit new opportunities or reduce dependence on existing markets. Organizations often adopt diversification strategies when existing markets become saturated or when new technologies create opportunities for expansion. Generic strategies. Generic strategies describe the main approaches organizations can use to achieve competitive advantage. According to Porter, businesses must decide how they will compete within their markets by selecting a clear competitive strategy. The model identifies 3 broad strategic options: cost leadership, differentiation, and focus. These strategies help organizations determine how they will position themselves relative to competitors and how they will deliver value to customers. Selecting an appropriate strategy allows a firm to organize its activities, resources, and processes in a way that supports its competitive advantage. If an organization fails to choose a clear strategy, it risks lacking direction and may struggle to compete effectively in the marketplace. Cost leadership involves becoming the lowest cost producer within the industry. Organizations pursuing this strategy aim to achieve efficiency through economies of scale, tight cost control, and efficient production processes. By maintaining lower costs than competitors, they can offer lower prices while still achieving acceptable profit margins. This strategy is particularly effective in markets where customers are highly price sensitive. However, organizations must ensure that cost reductions do not significantly reduce product quality or customer satisfaction. Successful cost leadership requires efficient supply chains, strong operational management, and continuous efforts to improve productivity and reduce unnecessary expenditure. Differentiation strategy focuses on offering products or services that customers perceive as unique or superior. Organizations adopting this approach seek to create distinctive features such as high quality, innovative design, strong branding, or exceptional customer service. Because customers perceive the product as different from competitors' offerings, they are often willing to pay a premium price. Differentiation requires strong marketing capabilities and continuous innovation to maintain the perceived uniqueness of the product. However, the organization must ensure that the additional value offered to customers justifies the higher price and remains difficult for competitors to imitate. Focus strategy involves targeting a specific niche market segment rather than the entire market. Instead of competing broadly, the organization concentrates on a particular group of customers, geographic area, or product segment. Within this niche, the firm may pursue either a cost leadership or differentiation approach. The focus strategy allows organizations to specialize and better meet the specific needs of a narrower customer base. Smaller firms often use this strategy to compete against larger organizations by concentrating on areas where they can develop specialized expertise or stronger customer relationships. However, reliance on a narrow market segment may increase vulnerability to changes in demand. Trend analysis. Trend analysis is a forecasting technique that examines historical data to identify patterns and predict future developments. It involves analyzing how variables change over time in order to identify long-term trends or cyclical patterns. Organizations often apply this method to sales figures, market demand, commodity prices, or economic indicators. By understanding how these factors have behaved historically, managers attempt to forecast how they may evolve in the future. Trend analysis is particularly useful in strategic planning because it allows organizations to anticipate changes in demand or cost conditions and adjust their strategies accordingly. However, its accuracy depends heavily on the assumption that historical patterns will continue. Time series analysis is a common form of trend analysis used to evaluate how variables behave over time. It examines historical data to identify patterns such as seasonal variations, long-term growth trends, or cyclical fluctuations. For example, retailers may analyze sales data across several years to identify seasonal demand peaks during holidays. By recognizing these patterns, organizations can improve forecasting accuracy and plan production, staffing, and inventory levels more effectively. Time series analysis helps organizations make informed decisions regarding capacity planning, pricing strategies, and supply chain management. When used effectively, it can improve strategic decision-making and operational efficiency. Trend analysis supports strategic forecasting and decision-making but has several limitations. One key limitation is that it assumes past trends will continue into the future, which may not always be the case. Economic shocks, technological disruptions, or regulatory changes can quickly alter historical patterns. Additionally, trends identified in data may reflect correlation rather than true cause and effect relationships. As a result, managers should treat forecasts derived from trend analysis cautiously and combine them with other forecasting methods and strategic insights. By integrating multiple analytical approaches, organizations can improve the reliability of their predictions and reduce the risk of strategic misjudgment.